Mutual Funds, Money Markets, and ETF by Kenny Hans. Mutual Funds. A mutual fund is a managed investment fund that pools money from investors to purchase securities for a company. These investment companies sell shares that are not tradable on secondary markets. How to buy a mutual fund. Mutual funds are bought and sold on the primary market. This means that they cannot be traded on any secondary markets such as the New York Stock Exchange, National Stock Exchange, or NASDAQ. Investors purchase shares directly from the fund at the net asset value, which is also known as the NAV. The fund is whatever the company's net asset value is, plus any sales charges that apply. These sales charges are often called the load or just load fee. After the company receives cash for the fund or funds, they will issue new shares and buy assets with the newly acquired capital. How to sell a mutual fund. Once an investor wants to sell or liquidate their position, the company will buy back the fund and will buy it back for the net asset value minus the load fee because it was previously paid by the investor. If the fund does not have the capital to pay the investor in their cash withholdings, they will sell securities to be able to owe the investor what they pay them. Key points. The key takeaways to buying and selling a mutual fund. With a mutual fund, it is extremely important to do research because you do not know how much you will pay for the fund until the end of the day. So if you put in an order to buy a fund midday, the price could be higher than what you expected to pay. Opposite from redemption, where the price could be lower than what the investor expected to receive. Since these are primary market instruments, there are no stop loss orders, no limit orders, or market orders for buying and selling the fund. How an investor will know the price is the net asset value plus any load fee charges the company could charge. Load fees. With the load fees, they could have a zero or a no load mutual fund, so you will only pay the NAV. The fees can range between 3 to 6% of the net asset value. If you buy a large amount of funds, usually the company will lower the fees due to the amount of funds that you have bought. Load fee example. If the net asset value is $100 with a 4.25% fee, you would do the following. You would take the net asset value divided by 1 minus the percentage. So in this example, I used $100 divided by 1 minus 0.0425. I got $104.44 after rounding up. The extra $4.44 is the load fee that the fund would charge. Other fees and or expenses. On top of the load fee, an investor must pay expenses for the fund. Each fund is legally required to give you their perspectives with the fee and expenses on it. The investor bears expenses that go with the compensation for management, brokerage fees when buying and selling, and researching assets. The compensation fee can be between 0.5 and 1%. All other fees can range between 0.3 and 0.7%. This means the total will be between 0.8 and 1.7% above the fund's asset. On top of that, there's an optional fee called the 12B-1. This fee is optional and companies do not have to charge you. It is a small fee ranging from 0.25% to 0.75% maximum. This fund is for marketing and distribution. How do I earn money from the mutual fund? The way investors earn is through dividend and capital appreciation. Capital appreciation is the difference between the purchase price and the selling price an investor pays and receives. Any dividend or interest earned is dispersed as income after the fund's expenses, such as management, researching, 12b-1, and brokerage. Specialized mutual funds. Mutual funds were originally made to help diverse one's portfolio of assets to spread risk and reduce loss. Investors now can input funds in specialized investments as part of an industry instead of a section. Example, someone can invest in gold, real estate, commodity focus, etc. How to choose the right mutual fund. First, you want to identify personal goals and decide how much risk you want to take on. Since there are different styles, you would like to determine what styles, such as sector, business, and industry. Look into what fees you might be paying, such as a front end load or back end load, to see when you might pay the fees. What sort of management, such as passive or active? Passive management needs to reach an index to maximize performance. Active is frequent trades to try to outperform the market. You want to look into results from the past from the company and look at the size of the firm or the fund. Exchange Trade Fund, also known as an ETF. ETFs are a type of security that tracks index, sectors, commodity, or other assets. It can be bought or sold on stock exchange such as the New York Stock Exchange, National Stock Exchange, or NASDAQ, just like any normal stock would. They can be structured to track anything from price to diversity to different strategies investors may use. How much is an ETF? An ETF's price will fluctuate throughout the day as they are being bought and sold on the market. ETFs are becoming more and more popular, with $4 trillion being increased between 2008 and 2018. As you can see from the chart, in 2008 they had a $0.7 trillion business in ETFs. Fast forward to 2018, you can see it's $4.7 trillion. Why one would want to choose an ETF? Rather than a stock, an ETF will hold multiple assets. Since there are more assets, they are highly sought after for their highly diverse portfolios. ETFs can hold hundreds of thousands of stocks across different industries, or if the investor wants, they can do one industry, one sector, or one business. Understanding the basics, passive versus active ETFs. Passive ETFs will track index of an industry, sector, business. The goal of passive ETFs want to match the index's performance. With an active ETF, you will hire a portfolio manager who will invest the money and their goal is to beat the index performance. Expense ratios. ETFs charge fees known as the expense ratios, and the ratio is an annual percentage. For example, a 5% fee for every $200 you spend will result in a $10 fee. When buying or selling an ETF, there is a commissions fee charged for every trade you may make. Different types of ETFs. There is bond ETFs, which could include government bonds, state bonds, corporate bonds, or municipal bonds. There is industry ETFs, which tracks one industry such as banking, oil, gas, etc. Commodity ETFs invest in commodities like oil and gold since they are highly sought after. Currency ETFs invest in foreign currencies. Inverse ETFs tries to gain earnings from stocks that are sold short. How to buy and sell an ETF. To buy an ETF, you must first open a brokerage account, look over the different types and compare and make a choice for which one fits you best and your goals. Number 3, invest money and let the ETF do its work. To sell an ETF, you can sell it anytime during the day like a normal stock. When you sell the ETF, there is usually a transaction fee from the broker that will charge anywhere between $10 and $20. How do I make money from an ETF? ETFs will normally give dividends to profit the investors. The investor then has a choice to either take cash dividends or have them automatically reinvested through the dividend reinvestment program. Money markets. The money market is trading very short term debt investments. It involves overnight transactions of any amount of money between banks and the US government. Most transactions are wholesale, which means they are between financial institutions and companies. More info. Companies and institutions that participate in money markets include lending money from bank to bank and bank to large company in Euro companies, which is money to help or traded outside the US. At also time deposit markets. How companies raise money is through commercial papers that can be bought by other companies. Investors can also purchase bank CDs as a safe place for their money and help banks lower their debt. Investors. Investors can join by purchasing money market mutual funds, CDs, US Treasury bonds, and municipal notes, debt issued by state, local government to gain capital. Investors can buy these at local banks and the US Treasury Direct website. An alternative route to buy these are brokers who will invest the money for you. Types of instruments. US Treasury bonds, also known as T-bills, are a form of money market instruments that can mature anywhere between a few days to a maximum of 1 year. CDs are considered money market instruments because they can mature within 1 year, but they can also take up to 10 years to mature depending on the individual and their set CD. Commercial papers are for trading unsecured loans for corporations who need the short term cash. These companies are very credited, so it is a low risk investment. Bankers' acceptances is a loan that is guaranteed by a bank strictly in foreign trade. A post dated check is an example. Money market goals. The goal of a money market is to be stable and have good security. The money market wants to keep a base net asset value of $1 so investors do not lose money. They rarely go under $1. Money market funds are not FDIC insured, meaning money markets cannot lose money.